Hello, everyone. Welcome to today's session. Sorry about that delay. Couldn't get logged in for some reason here. So I think we are up and running. Should be able to see my screen here and hopefully hear me. So let's jump into it today. Market conditions still remaining bullish in this current bull market. Overall uptrend still now approaching the upper end of that range on price activity. If I just jump down to this chart right here, this S&P 500 chart, the 1 year time frame, we've had this retracement now pulled back. Now we're retesting this upper limit, this 564 range, really without any kind of a retracement at all. It's just been a moonshot from there straight to there. So I wouldn't be surprised to see some kind of consolidation here, or potentially even a retracement back to this zone. That would be, certainly not unexpected. We certainly could see a range. We've been here now for a week or two towards the upper end of that range. We could see a breakout right here also. We'll get a little bit better perspective than that here shortly. But one of the other bullish things that's happening here, there's a couple of bullish things on this chart. Number one is that sentiment is back on top. Okay, typically early in the stages, early in a trend, when we have sentiment that's weakened, a larger, longer, significant trend where that sentiment, that blue line, starts to get underneath everything else, then you start to get that opportunity for demand to come in. When everybody's bullish, at some point there's nobody left to be bullish, right? So it's the supply demand where when everybody is bearish, then there's probably a reason why there should be an opportunity for the bulls to step in. So when we're at this lower level and we get a really quick shot up with momentum, this is usually what significant bottoms look like, is a shot right off leading with momentum and breadth. Okay, and once they start to top out, then sentiment gets up here. We're still at that level. Sentiment is high, which is, again, it's fear of missing out. It's market, stocks are the place to be, particularly with interest rates coming back down, or anticipated to come back down over the next year. And as long as we don't deal with recession, that could be the case right here. But this can last a long time. This blue line can stay up here for quite some time. And particularly when we have it with breadth up this high, that's also a good thing happening right here. So we have some good things, some positive things happening still, even though we're at the upper end of this trend. That could, that can always change rapidly. But we're seeing, as far as today, we're seeing breadth continuing to work well also, and sentiment towards the upper end of that range. We did see buy-sell ratio tick back a little bit yesterday, and pulling that back down to that 2 to 1 essentially. So there's 2 buys for every sell in the database at this point. So you have positive breadth. Those are bullish conditions that buying into stocks in these uptrends or give you a little higher probability of those markets actually advancing. Sentiment, we are at the upper end of that range, above 50. Again, could use a little bit of a pullback here on S&P 500. If we look at that chart, we've got resistance right here's that 565 range. Here's that 554 range that we talked about. So we've had 1, 2, 3 tests of the 554 range, and that's significant because it's been here before. These places where price have been before, we want to see a reaction at those levels, or even buying at those levels. It starts to happen, and so we're starting to see that these levels are there's some demand happening. That's a good sign. It's a bullish sign for more upside. When this breaks down, this next level, this 554, if it were to retrace, we were to get a close back below that level, that still would put us in the momentum zone at 236, but it may also be an indication that something is weakening, or a little bit deeper retracement may be happening. The fact that we've got this really tight consolidation right here, tight meaning it didn't have a lot of real big swings up or big swings down. It's just tight, consolidated. That's also a good bullish sign here as well for some continuation. That's S&P 500. The other things that are driving the market right now, obviously, always earnings are ultimately what drives the market, because stocks are nothing more than a present value of the future earnings of companies. But some of these other factors can play with those earnings. You get interest rates that are too high for too long. You get oil prices that are too high for too long. You get some of those scenarios that hurt companies and ultimately hurt earnings. Then the stock price is going to suffer. So we want to pay a little bit of attention to some of the bigger economic things. And really, right now, really the only thing to really be paying attention to are interest rates and bond prices. So we've been spent a lot of time on TLT, spent a lot of time on SHY, and they're still holding up right here. They still look good in terms of what the bond market is anticipating of a trending higher bond price, meaning lower interest rates, and so that's still intact. That confidence still there, where you're just getting a more of a corrective counter trend now of an overall uptrend. This being our overall uptrend, and then just the retracement. Remember, this 236 is kind of our volatility zone. We're okay with a certain amount of volatility inside of that range. If it breaks down under that range, that's sometimes, not always, but oftentimes a indication that we're getting a deeper retracement or pullback, or even a new trend direction or a continuation of a trend direction. This one's been holding up pretty nicely, where you're getting higher highs now on each of these support areas, and so that overall trend still looking decent for TLT, and SHY really similar. SHY, we want to see that one really accelerating faster than TLT. And remember why. The reason why is on this bond yield curve, that SHY would be, if that's rallying faster, that means these interest rates are dropping faster, and that's what we want to see. We want to see the short end of this yield curve. This is the short end of the yield curve. This is the long end of the yield curve, just represented by the maturity, okay, of the bond. So you have a 3-month, that's short. You got a 30-year, that's long. So we want the short end of this yield curve to drop back down again, and that means if we're watching SHY and it's moving up, then we know that's starting to happen, okay, or at least that's anticipated to happen in the bond market. The bond market is anticipating additional Fed fund rate cuts and things like that. That's going to affect this perspective as well. Now that's the overarching economic perspective. Bonds and interest rates, they just play a part. Inflation plays a part, and interest rate, the ease of money, the amount of liquidity that's out there chasing things it just matters. It matters in terms of how the stock market perceives the future of earnings for different companies. If they anticipate that these things could slow the earnings of companies, oftentimes that will create some selling in stocks. But as of right now, the market's not concerned too much. They were, last week, 2 weeks ago, this sell-off that we had right here, that was starting to become concerning, but ultimately those fears went away in a hurry. We're right back to where we were essentially a month ago, which is pretty crazy, honestly. Let's take a look at some of the sectors. We're seeing continued strength in sectors. We had 2 little downturns here on the short-term trend for energy and technology. Energy, that's not surprising because it's already in a downtrend here. Okay, this is not USO. This is the energy sector. So these are going to be energy stocks, essentially, as an entire sector, and that's been continuing to drop as we've seen oil continue to drop. So this commodity tab, we go over to USO, looks very similar to this is the price of oil itself. So I've been seeing that a little bit here in energy. Technology still holding up. This looks very similar to the triple Qs pattern, and you can see where it's stuck inside of this range now. This is it's a good visual representation using these Fibonacci tools, these lines where you've got this range, and then you can see visually that where it needs to be and where it's playing, where the range of activity is happening. It's right here. Okay, so we should see buying at this 145 range. We should potentially see some selling or some resistance, but as we break up above that level, that just gives us more confirmation that that trend is moving in that direction. But technology here just pulling back and couldn't quite seem to break out of that level. We'll see if we get that here or not over the next few days and weeks, but really looking good as far as the overall perspective of the sectors. Commodities, gold continuing to move. Gold might get another breakout here if it could. It's sitting exactly at those highs. These are not only short-term highs, but these are all-time highs in gold. This is 230. This is GLD. So this is the ETF. This doesn't represent the price per ounce of gold itself, but it ends up being, I think they try to mimic it pretty close by a tenth. So it's like 233, where gold might be $2,300 an ounce. It's not exact, but relatively close. So gold prices moving up well over $2,000 an ounce now. You're seeing, that often becomes a flight to quality, particularly if we're dealing with the dollar and we're dealing with interest rates and we're dealing with debt and we're dealing with deficits and some of those things that start to come into play. We've ignored them essentially as a society and as an economy for 40 years, 50 years. But in terms of a real, true, pure store value of a methodology to store real value, gold is always going to be there, and it's always a flight to safety. It's always a way to be able to, for all the doomsdayers that say that the world's coming to an end, let's go buy gold. Okay, there's definitely a place for it in a portfolio, whether it's the actual physical asset. I own gold coins, and it's kind of fun because you just, you've got this hard asset that you can hold on to, and it's sitting, the gold's sitting right next to my ammunition and my Campbell soup cans, and my pork and beans too. So those are the things I'm going to need when the zombie apocalypse takes over. But nonetheless, GLD, nice looking pattern right here to the upside. And let's see what USO. We just looked at that as well. Silver kind of been lagging, but similar type pattern. We could see a breakout in silver. We often see a lot of times those miners, if you're looking over here and go to the sectors, go to the sector scan. If you go down here to where is it, basic materials, then you can go in and really look at some of those miners. You've got miners, you've got different sectors inside of that as well. Let's see if we can find out what's right here. So gold and silver. So you can see some of the breakdown of some of those stocks inside of that. So you can choose that 15 and say, these are the leading stocks in that gold mining sector. What do those look like? Okay, are those patterns set up decent? You've got IDR, which is really having a nice move here, big solid breakout. So typically you'll see the gold miners perform a little bit better than gold itself. And because you think about what's happening here, this is the product that these guys are producing and selling. They're digging this stuff out of the ground, and if they can sell it for $2,000 an ounce instead of $1,000 an ounce, just the fact that the product that they're producing or mining is more valuable to sell, they should be able to make more money out of it. So you get these gold miners that are improving, pretty nice runs here, run up here in most of these gold mining stocks. So keep an eye on some of those. Some of them have pretty decent, tight patterns where they're breaking out or moving higher. We do own one in the wheel portfolio currently, that is NGD. It's had a little bit of volatility here recently, but it's back to support once again, sitting right around these range. So that's a way to be able to look for some individual gold stocks as well. Sometimes you can also catch a leveraged ETF. You've got Ultra Gold ETF here, UGL. You've got lots of those happening inside of some of these groups. Let's see if we can find some of those miners. It's not going to pop out of me exactly. Sometimes it's the you can get just the leveraged of GLD. Other times the actual miners themselves. Anyway, I'm not going to spend too much time, but there's also ways to be able to magnify that return by using a 3x leveraged ETF on the entire sector or on gold itself. That's a way to be able to diversify and get a little leverage off that. So that's currently moving, something that's also in play and to be considering right now as well. Let's jump over and look at some muscle stocks to see if there's anything of interest and talk about any kind of potential setups here. When I'm scrolling through, I know what I'm looking for pretty quickly, and it's something like this. Like, we want to be in the momentum zone ideally. If it's something lower, like maybe like this, these are still interesting plays. You may have to go out a little bit longer time frame and see what the trend is. Why is it so highly ranked? Yet on a 6-month time frame, it looks like it's having a big downtrend. The rank is based on the 1-year time frame. So if you look at a 1-year time frame, this stock IMNM had a really huge run from $8 to $30, gave it all back, and now is attempting to move back up again. You can see the whipsaw happening here. The whipsaw can happen on any potential trend reversal, whether that's happening here or whether it's trying to break up here and fight that trend, or if it's ultimately in a downtrend. Okay, so you can still get whipsaw. The fact that you've had one, this one didn't stop out technically, probably would have if we had had a little tighter stop, but it's early in those trends. Those can have a little, those can really get you in early opportunities to catch the bulk of the run here. Okay, but a lot of the times it's a grind to get back to, because you've got resistance, you've got resistance, you've got resistance, you've got resistance. Okay, so a lot of times it's that overall resistance. Once that resistance is gone, then that's the trend ideally that we want to try and focus on and trade and capture those kind of stocks. These can still do that. These stocks that are bottoming out, a little bit deeper retracement, they can still have interest, but sometimes they just don't have the same interest that they had here. Once bitten, twice shy scenario of trend following of momentum stocks is oftentimes what was leading in the last rally may not lead again ever, or it may, if it's a stock that's kind of lost its way, or if it was just a little speculative fervor that took place in a certain group and sector, that can pull all the stocks up with it. So one of the filtering methods, again, if I'm looking for just pure momentum, that's easy to just skip over. And then I would come across a stock like this. This actually is a stock we traded back here on this signal, and we ended up getting out pretty close to the top and then some stop out. So as we're entering, there's ways, again, we talked about this on Tuesday, ways to sell on the way up, where once you're at a certain percentage of gain, whether that's 10% or 15% or 20% increase on your overall position, and you say, once I hit that, let's call it 10%, I'm going to sell 25% of my shares. Okay, I'm selling into the strength, not the entire position, but some of the position, 25%, or you could even go 50%, whatever that percentage is. Sell something on the way up and then trail stop on the rest. And in this case, this reversed, came back down. Now it's back in an overall uptrend, and it's back to the momentum zone, had some good earnings. So you've got a big, nice gap here. So relatively early, potentially in this trend. These guys do a lot of reconnaissance drone type products for military. It's a pretty cool company, and not surprising to see that it had decent earnings, because I think the company as a whole, it's got a great product and a great idea. But you get, momentum stocks, you get all of these things. You're overshooting to the upside, overshooting to the downside. That's the nature of stocks. So as the quick glance, and you're looking to say, okay, here's a trade that I may want to take. I like the idea, I like the price pattern, I like the location, big volume, increased day right here, and say, look, what are we going to do? How are we going to go about this? Well, let's jump in and say, if I had $100,000 on this account, current value is at 200, so if I had 10 shares, it's going to put me right at my 2%. Okay, so if we're managing the risk at 2%, then we're right on target for this. And that's without the stop loss. We want to say, what is our risk for the entire trade? If everything came unglued and I lost everything on this stock and it dropped to zero, what is that? That's 2,000, or 2% of my entire trading account. Plug in your own trading account there so that you are getting the accurate numbers. And then we apply the stop loss. So we've got a couple of areas on this. With a gap, sometimes those stops become a little bit tricky, because ideally the best place for the stop loss is at the most recent low, or the most recent low of the hold signal before it goes back to buy. So that puts us all the way down here to 174. So let's look at 174.70. Let's put it at 175 and see what that number looks like. So if we go 175 on a stop loss, okay, that puts us at 0.29. Okay, my trading plan risk level is 0.3 higher or less. So anything less than 0.3, and a lot of times we've been getting 0.2 or 0.17. But this essentially put us right at the maximum risk that we would be willing to take based on this current trading plan, and that's okay. Okay, that's fine. And that if you want to go to that upper level or whatever that upper level becomes for you in your trading plan, then that's fine as well. Okay, it's all about where you feel comfortable with your risk tolerance and saying, yeah, okay, 300, that's my risk. It's a pretty wide stop. That's a 14% stop. After a big earnings report, what are the chances that it goes from here all the way back down to here again? And should I be willing to wait for it to drop all the way back here before I got out of it? Or should I say, it's the probabilities are pretty low that it even gets back to here, back to 180, let's call it 183. So I could tighten up my stop here and say, let's go 183. And that puts us at a 10% stop, 0.2. That's where I've been kind of tuning in, at least for the risk parameters on most trades recently, because of how lofty market conditions are. But one of the things right now, if the market conditions are looking bullish, if interest rates could pull back a little bit, if we see momentum continuing to move higher, inflation moving lower, company profits improving, then we may be willing to take on a little bit more risk on a per trade basis. Okay, so if I did that, I'm dealing with these two things, right? We adjusted our risk by adjusting that number. That changed this from 300 down to 221. So I can say I'm willing to take $221 of risk at a 10% stop, or I could say, let's go a little bit deeper and allow that for some volatility. A lot of the times, if you're willing to allow the volatility, that's okay, but there may not be a need for that. If it's right here and say, if it traded back to 185, I would want to be stopped out. I wouldn't want to wait around and see why in the heck did it drop from here to here. So that actually would be, you can adjust those based on the way you see that as well. You can go, all right, I'm just going below the zone. I'm going below the 382 zone right here. That's 186. So I could go right below that alone and make sure maybe I'm a little bit below that. But if I did 186 on that stop loss, I'm at 0.18. I'm at $190 even now instead of 220 or 300 at risk. It's a tighter stop, but I should be warranted in having that tight of a stop. It's not that tight of a stop. It's not like we're going underneath this bar right here. That would be a really tight stop. So if it traded below this bar, so you can also go the two ways: increase your position size and tighten your stop. If I said, let's go with the little tighter stop, let's go with the low of this bar right here, which is 191. If I did a stop at 191, that's 141, that's a 6% stop. I may be able to buy more shares now. Maybe instead of 10 shares, I buy 13 shares. Okay, now this number is going back up again. Okay, so I'm taking more risk now by changing the position size. Now I've got 15, but look what my position size is now. Instead of 2,000, I'm 3,000. So I'm at 3% at risk by taking on a tighter stop and more shares. I'm managing this number. That's really all I care about. That's the only thing that we have the most control over. The market's going to do what it does. We try to do as many things as we can to catch an edge so that we're getting a stock that has a high probability of continuing its advance higher, but that just doesn't always happen. And so we need to make sure that we're comfortable with this level as well. But I may want to have a bigger position size so that I can take more risk, but I still want to have a really tight stop because I'm still only willing to risk 200 on $3,000 instead of 200 on $2,000. That's my position size. That's the size of the position. Very, very important to understand that. Once you really grasp your mind around your position size and how that affects everything else, then the stock picking part of it is still just that. It's still just stock picking. Some are going to go up, some are not, and it doesn't have to be quite as precise. It's even better if you're catching winners that are continuing to move higher, but understanding the risk profile on the setup each time as well is by far the most important part of trading, setting up your position size and your stop loss, and always use a hard stop, no matter what. Unless, I shouldn't say no matter what, but always use a hard stop unless your position size is your stop. Okay, so if I had no stop loss at all, I said I'm not going to have a stop loss on this stock at all because I believe in it and I'm willing to have it do what it's going to do, and I really don't care if it retraces or whatever the rationale is. You're not going to use a stop loss. you have to adjust the risk by your position size. Okay, so if right now my risk is $3,000. If I wanted much less than that, if I wanted 1% at risk, okay, that's $1,000 at risk. If this stock dropped to zero, I need 5 shares. Okay, so if you're not using a stop loss at all, the way to manage your risk is still on your position size, the number of shares that you're using, so that you can manage those effectively. It's never a good idea to say, I'm just going to buy it because I know this thing's going higher. I just know it. You know, everybody out on YouTube says it's going higher, and so I just know it. It's never a good idea to just know it, because the market will prove to you otherwise. And so you always want to make sure that these things are taken care of. If that's taken care of and this is taken care of, then let the market do what it's going to do. It's gonna stop you out sometimes. It's gonna rally sometimes. It's gonna be volatile sometimes. It's gonna do nothing sometimes. It's just the way that markets operate. But this part of it allows you to mentally and financially create the structure so that you can have some volatility and continue to play and continue to have growth and have success over time. Because it's never fun when you're like, I'm going to buy XYZ stock. I'm going to buy 20,000 of it, and it drops by 20%. And it's a painful experience. So making sure that those position sizes are working for your lifestyle, for your risk management. They call that suitability. Is it suitable for you? If you don't know if it's suitable, then you don't realize how much risk you're actually taking, and that's even more dangerous, because it's I don't care if it's $1,000 or if it's $100. It's still money. It's still money that we all work hard for. I just don't want to chuck it out there and see what happens. I want to have a plan and a strategy so that I can be ahead of the game most of the time. I realize that that's not the case all of the time, but most of the time we want to be able to grow and increase based on stock strategies and utilizing these uptrends, utilizing companies like this. A stock that's doing well, that's moving higher, that has opportunity, that there's demand, they got a cool product, they're making money, price is going higher, and best place to look for those to start out are in these new buy scans. And you're going to find some, as I've mentioned before, you can create scans that have some additional criteria to say, I want volume. Okay, let's look over here at this new buy volume. I pulled this up last time, but I don't think I actually ever looked at the screen criteria. Let's do that right here. So when you go over to the screen criteria and you add in this one, new buy volume, let's look at the criteria here and see what I have. That's just the default. Let's go back here. Here it is. Okay, so on this one, I've got it set to $1. Market cap, relatively small, 250 million. You can see how much higher you can go on market cap. Again, market cap is just the number of shares outstanding multiplied by the stock price. And oftentimes, if you have millions and millions of shares outstanding, like Apple or Microsoft, and they've got a $200 or $300 share price, you're going to get a huge market cap price. Okay, the value of the company, as far as the market value of the company. And so this is just, is it a big company? Is it a little company? This one I want to have plenty in, but this has given me a volume increase of 50% over the prior day, and it's gone from a hold to a buy. Long-term trend also has to be up, and then anything ranked 90 or higher. So that just filters this down a little bit, so you can see, of the muscle stock group, okay, there's going to be some in there. You can see we had AVAV, the other one that was there, I can't remember now. But these three may be like, oh, okay, these are the only three I'm really interested in. More than likely, they're going to fit inside of my parameters. That one does. AVPT, this one does. In fact, we bought this one today into the wheel portfolio. And MTTR, let's see that. Sometimes too, if these are big gaps, you just want to double check, make sure that that's accurate data. Sometimes our split updates and things like that may not have fully updated, so you can check on that as well with your brokerage account. But that's another way to just zoom in on the quality of the pattern that you want to utilize. I like including volume. For a long time, I considered volume not to be as significant because it was still more about price. But the volume, it definitely works to show those supply demand locations and where they're coming in. When you get massive volume and massive gap, those are heavy hitters that are investing long term into this company. Well, the other value with volume is when those guys are buying, guess what? They don't buy on a day. They buy over the course of 3 months. And so they'll buy a bunch early on, but then there's the average volume is going to increase every pullback. They accumulate. I'm talking about by they, I'm saying pension funds, hedge funds, mutual funds, billion-dollar funds, the BlackRocks of the world that are accumulating. When they buy into a stock, they have a hard time trading those stocks because they're so huge. It takes them months to accumulate, and ultimately, the little hint is in big volume to begin with, and that can continue to advance that volume even higher. So when we're seeing a volume spike the day before as well, like on this, and you get a big gap at a price location, you're just saying, for whatever reason, there is institutional interest. Institutional interest moves the market and moves the stock, and we want to be able to see that. And in this case, the average volume here is 3 million shares a day. So it's trading a lot of volume. To have even a bigger spike on this is moving the needle on that. Let's see. I'm gonna go. I wanted to go a little bit longer here just so that we could make up for my 5-minute delay. But just to recap here, market conditions, we've got to still be paying attention to that yield curve. That's going to be an issue. How is it going to be corrected? How is it going to correct itself? It has to look like this again. It's got to be a normal yield curve. But typically, look where that happens. It can happen during an uptrend as well. But you can see once we had COVID, once we had this retracement, now we've got inflation. It's still that inflation issue that's still got to be taken care of. I'm seeing in our area, I'm seeing a whole bunch of real estate on the market now. People are like starting to list their homes. It's a 10-year high here in Utah, and so we may start to see the fact that these interest rates are so high for so long that they're waiting to sell their homes. They're like, oh, this isn't going to change. We got to start selling. We haven't seen a pullback in real estate. We haven't seen a pullback in the stock market because of interest rates, at least not yet. Okay, so that's one of the things to be watching for. I should say, I mean, watching price activity is going to be the most important thing as well. The stock market's going to let us know what it knows, when it knows it, and right now it's okay with the information that it's got. That at least that's live information that's current. That'll do it for today's update, everyone. I sure appreciate everyone's time and effort, and have a fantastic weekend. We'll see you next time. Bye now.